In 2025, the Federal Reserve made a very specific announcement. They're keeping interest rates elevated longer than expected. If you're watching inflation eat into your paycheck right now, you might think this is a desperate reaction to unprecedented times. It's not. This is a playbook. The same three-move strategic sequence the Fed has run twice before in modern history. Once in the 1970s, when inflation hit 14% and they crushed it by destroying the economy. Again in 1980, when Fed Chairman Paul Volcker raised interest rates to 20% and triggered the worst recession since the Great Depression. And now, in 2025, they're running it again. Same three moves, same sequence, same devastating outcome for everyone who doesn't see it coming. Here's the playbook they're using. Here's what move we're at. And here's the timeline for what happens next to your savings, your job, and your cost of living. The Fed's Inflation Playbook. This is what I call the Fed's Inflation Playbook. It's a three-move strategy the Federal Reserve uses when inflation gets out of control and threatens the credibility of the entire monetary system. The playbook works because it doesn't fix inflation through policy innovation or economic reform. It fixes inflation by deliberately engineering economic pain. They break the economy to save the currency. And they've done it the exact same way, twice before, with catastrophic consequences for ordinary people both times. Let me show you the three moves, how they played out historically, and why 2025 is following the exact same script. Move 1. Deny the problem until it's undeniable. You don't start a painful economic strategy by admitting you have a problem. You start by insisting everything is under control while the fire spreads. Because if central bankers admit inflation is out of control too early, it triggers panic, markets crash, politicians demand action, the public loses faith in the currency. So move 1 is always the same. Deny, delay, and call it transitory until the data makes denial impossible. Historical example, 1972, 1973. In 1972, inflation started creeping up in the United States. Consumer prices were rising faster than expected. The Federal Reserve, led by Chairman Arthur Burns, insisted it was temporary, a short-term blip caused by supply chain issues from the Vietnam War. He kept interest rates low. He assured the public the Fed had everything under control. But by late 1973, inflation hit 8%. Then 10%, then 12%. Oil prices quadrupled after the OPEC embargo. Food prices surged. Wages couldn't keep up. The denial phase was over. The Fed had waited too long, and inflation was now embedded in the entire economy. Historical example, 1977, 1959. Fast forward to 1977. Inflation had supposedly been fixed by the mid-1970s recession, but it came roaring back. Once again, the Fed under Chairman G. William Miller insisted it was manageable. A temporary spike that would self-correct. He kept rates relatively low, prioritizing economic growth and employment over price stability. But by 1979, inflation hit 13%. The dollar was collapsing. Gold prices exploded from $35 an ounce in 1971 to over $800 by 1980. The public was panic buying hard assets. Foreign governments were dumping dollars. The entire global monetary system was at risk. Move 1 had failed again. Denial only made the eventual reckoning worse. Modern parallel, 2021-2022. In early 2021, inflation started rising in the United States. Consumer prices jumped, supply chains were breaking down, money printing from COVID stimulus was flooding the economy. Federal Reserve Chairman Jerome Powell had a choice. Raise rates immediately and prevent inflation from taking hold, or wait and hope it resolved itself. He chose to wait, and he used the exact same language as his predecessors. Transitory. That was the word. Inflation is transitory. It'll go away on its own once supply chains normalize. He kept interest rates at near zero throughout all of 2021, even as inflation climbed to 5%, then 6%, then 7%. By late 2022, inflation hit 9.1%, the highest in 40 years. The denial phase was over. Move 1 complete. The playbook was running exactly on schedule. Move 2. Shock the system with aggressive rate hikes. Once denial is no longer possible, the Fed moves to the opposite extreme. They don't gradually adjust policy. They shock the system with the most aggressive interest rate increases in modern history. The goal isn't to gently cool the economy. The goal is to break inflation's momentum by making borrowing so expensive that businesses stop investing, consumers stop spending, and unemployment rises sharply. It's economic chemotherapy. You poison the entire economy to kill the inflation cancer. And just like chemotherapy, the side effects are brutal. Historical example, 1979, 1981. In August 1979, President Jimmy Carter appointed Paul Volcker as chairman of the Federal Reserve with a single mandate: kill inflation, no matter the cost. Volcker didn't ease into it, he shocked the system. In October 1979, he raised the federal funds rate from 11% to 15% in a matter of months. By June 1981, interest rates hit 20%. the highest in American history. Mortgages became unaffordable. Home sales collapsed. Small businesses couldn't get loans. Car sales plummeted. Unemployment spiked from 6% to over 10%. The economy entered the worst recession since the 1930s. Entire industries were devastated. The Rust Belt was born as factories shut down permanently. But inflation broke. By 1983, it was back down to 3%. The Volcker shock worked. But millions of Americans lost their jobs, their homes, and their businesses in the process. Modern parallel, 2022-2024. In March 2022, Jerome Powell finally abandoned the transitory narrative. Inflation was real, persistent, and dangerous. He moved to aggressive rate hikes. Not 20% like Volcker, but the fastest pace of increases in 40 years. The Fed raised rates from near zero in early 2022 to over 5.5% by mid-2023. 7 rate hikes in less than 18 months. Mortgage rates doubled from 3% to 7%. Housing affordability collapsed. Home sales dropped to the lowest levels in decades. Credit card interest rates hit 20%. Auto loan rates surged. Small business loans became prohibitively expensive. Tech companies started mass layoffs. Startups couldn't raise capital. Banks started failing, like Silicon Valley Bank in March 2023. The economic pain was spreading exactly as designed. Move 2 was in full execution. Move 3, hold rates high until something breaks. This is the most brutal part of the playbook. Once rates are elevated, the Fed doesn't cut them at the first sign of economic weakness. They hold them high until something in the financial system actually breaks. Because if they cut rates too early, inflation comes roaring back, and the entire painful process was for nothing. So they wait. They hold. They watch unemployment rise, businesses fail, and markets crash. They're waiting for what economists call demand destruction, the point where consumers and businesses are so financially damaged that they simply stop spending even if they want to. And then, only when the economy is truly broken and inflation is definitively dead, do they finally cut rates and allow the recovery to begin. Historical example, 1981-1982. Paul Volcker raised rates to 20% in June 1981. Inflation was falling, but he didn't declare victory. He held rates elevated, unemployment kept rising, 9%, then 10%, then 10.8% by late 1982. Construction stopped, manufacturing collapsed, bankruptcies surged. The pain was unbearable. Politicians demanded he cut rates. Volcker refused. He held the line. He waited for inflation to fully break. Only in late 1982, when inflation was clearly dead and the economy was in ruins, did he begin cutting rates. The recovery that followed was strong, but it came after millions had already lost everything. Modern parallel, 2024-2025. We are here. Jerome Powell raised rates aggressively in 2022 and 2023. By mid-2024, inflation had fallen from 9% to around 3 to 4%. Markets expected rate cuts. The Fed held. In 2025, Powell is still keeping rates elevated, between 4.5% and 5.5%, despite economic stress signals flashing everywhere. Unemployment is starting to tick up. Corporate bankruptcies are rising. Credit card delinquencies are at the highest level in a decade. Commercial real estate is collapsing. Office buildings sit empty. Regional banks are struggling with bad loans. But the Fed isn't cutting. Powell has stated clearly, rates will stay high until inflation is fully defeated and stays defeated. This is move 3, the holding pattern. The economy is weakening, but the Fed is waiting for something to break before they act. The pattern is identical. Let's compare the 3 playbooks side by side to see just how precisely history is repeating. 1970s playbook. Move 1, deny inflation, 1972-1973. Move 2, shock with rate hikes, 1979-1981. Move 3, hold until economy breaks, 1981-1982. 1980, playbook move 1, deny inflation's return, 1970-1979. Move 2, Volcker shock, 20% rates, 1979-91. Move 3, hold through 10.8% unemployment, 1981-1982. 2020s, playbook, move 1, call it transitory, 2021-2022. Move 2, fastest rate hikes in 40 years, 2022-2024. Move 3, hold rates high despite stress, 2024 to 2025. We're here. The sequence is identical. The timeline is nearly identical. Even the language is identical. And if the pattern holds, the outcome will be identical too. A painful recession that finally breaks inflation, but destroys millions of jobs and businesses in the process. What this means for you. So what does this playbook mean in practical terms for your money, your job, and your future? For your job and income. If the Fed is running the same playbook, unemployment will continue rising through 2025 and possibly into 2026. We're currently at around 4%. History suggests it could hit 68% before this is over. Industries most vulnerable. Anything dependent on credit or consumer spending. Tech, retail, construction, real estate, automotive. Layoffs will accelerate. If you work in a leveraged industry or a company that relies on cheap borrowing, prepare for potential job insecurity. For your savings and debt, high interest rates mean two things. If you have savings in safe assets like treasury bonds or high-yield savings accounts, you're finally earning real returns for the first time in 15 years, 4 and 5% interest on cash. But if you have debt, especially variable rate debt like credit cards or adjustable rate mortgages, your payments are going up and staying up. Credit card debt at 20% interest is financially crippling. The playbook suggests rates will stay high for at least another 12-18 months minimum. Plan accordingly. For the housing market, the playbook doesn't predict a housing crash like 2008, but it does predict continued stress. High mortgage rates mean affordability stays terrible. Home sales stay low. Prices may flatten or decline in some markets. If you're waiting to buy, the playbook suggests you might see better opportunities in late 2025 or 2026 when the Fed finally cuts rates and sellers capitulate. If you're selling, you're in a difficult spot. Buyers can't afford high rates and inventory is building. For the stock market. Historically, the stock market performs terribly during move 3 of the playbook. In 1981, 1982, the S&P 500 dropped significantly before recovering. In 2025, we're seeing similar stress. Tech stocks are vulnerable because they rely on cheap capital and future growth. Value stocks and dividend-paying companies with strong cash flow perform better. The playbook suggests a recession is coming in 2025-2026. Markets typically bottom 6 to 12 months before the economy does. Watch for that inflection point. For inflation and your cost of living. The good news. If the playbook works, inflation will be defeated. Your grocery bills, gas prices, and rent increases should stabilize or even decline. The bad news. The cost is a recession that makes earning money harder, even as prices stabilize. You're trading high inflation for high unemployment. The timeline based on the historical playbook, here's the likely sequence for the next 18 months. 2025. The Fed holds rates high. The economy weakens, unemployment rises, corporate stress increases. Something significant breaks in the financial system, a major bank, a sector collapse, or a debt crisis. Late 2025 or early 2026, Fed finally pivots and begins cutting rates in response to the crisis, not because inflation is fully gone, but because financial stability is at risk. 2026, 2027, recession officially declared. Markets bottom. Recovery begins slowly, unemployment peaks, and then starts declining. This isn't a prediction. This is the pattern repeating for the third time in 50 years. The counter-argument. Now let's be honest about what could break this pattern. Because the 2020s are different in some important ways from the 1970s and 1980s. Modern difference 1, the debt burden. The United States has $34 trillion in national debt. In the 1980s, debt to GDP was around 30%. Today, it's over 120%. High interest rates make servicing that debt incredibly expensive. The government is now paying over $1 trillion annually, just in interest. That's unsustainable. If rates stay high too long, the federal government might face a debt crisis that forces the Fed to cut rates earlier than planned, even if inflation isn't fully defeated. Modern difference 2, global interconnection. In the 1980s, the U.S. economy was more isolated. Today, global supply chains, international finance, and foreign dollar dependency create systemic risks the Fed can't fully control. A prolonged period of the high U.S. rates could trigger crises in emerging markets, currency collapses abroad, or trade disruptions that force the Fed's hand. Modern difference 3, political pressure. We're heading into the 2024-2025 political cycle. Elected officials will pressure the Fed intensely to cut rates and avoid a recession before elections. The Fed is technically independent, but political pressure in a democracy is real. If unemployment spikes too high, the pressure to abandon the playbook early becomes enormous. So yes, the 2020s playbook could break or be abandoned before it fully completes. The Fed might be forced to choose between killing inflation or avoiding financial catastrophe. They might not get to do both. But as of right now, in early 2025, they're following the script perfectly. The bottom line. Here's what you need to understand. The Federal Reserve is not improvising. They're not reacting to each new data point in real time. They're running a playbook. The same playbook they ran in the 1970s and 1980s when inflation got out of control. Move 1, deny the problem. Complete. Move 2, shock the system with aggressive rate hikes. Complete. Move 3, hold rates high until something breaks. In progress. And if history is any guide, Move 3 ends with a recession, rising unemployment, financial stress, and eventually rate cuts and recovery. The timeline suggests we're 12 to 24 months away from the bottom. late 2025 or sometime in 2026. This isn't about fear. This is about recognizing a pattern that's been run twice before with predictable outcomes both times. If you understand the playbook, you can position yourself accordingly. Hold cash for opportunities. Reduce variable rate debt. Protect your job security. Avoid overexposure to leveraged assets. And if you're waiting for the Fed to save the market or cut rates to help the economy, understand this: they won't. Not until inflation is dead. Not until something breaks. That's the playbook. That's the pattern. And right now, it's running exactly on schedule. The only question is, will you see it before it's too late?